Welcome to the Department of Distance and Continuing Education, University of Delhi, Master of Business Administration, Semester 1, Core Course MBA FT 6103, Managerial Economics. Lesson 4, Theory of Cost. 4.1, Learning Objectives. After studying this lesson, you shall be able to understand the cost of production and related cost concepts, learn about the traditional and modern theories of cost, plot various cost curves, comprehend the relationship between different cost curves. 4.2 Introduction. Cost of production refers to the expenses incurred when producing or obtaining items and services that bring in money for a business. Cost incurred by a company during the production of its goods and services are a crucial factor in decision making. It includes both direct and indirect cost. Direct costs are those that can be linked directly to the production of a product, such as labor and material cost, whereas indirect costs are those that cannot be linked directly to the product, such as overhead. Profit is every business's ultimate goal, and a company's capacity to generate consistent profits determines how prosperous it will be in the long run. The profit margin of a business concern is determined by total cost and total revenue. A company works to raise revenue and cut expenditures in order to maximize profits. The profit margin of a business concern is determined by total cost and total revenue. A company works to raise revenue and cut expenditure in order to maximize profits. While a corporation often has no influence over the selling price, it does have control over a number of costs. Therefore, the business should strive to minimize and control costs. Since costs are taken into account in every business decision, it is essential to comprehend the meaning of various terms in order to think strategically. Significant cost estimates that are helpful for managerial choices can be obtained from an analysis of economic costs when supplemented with information derived from the company's accounting records. If management intends to arrive at cost estimates that are relevant for planning purposes, the reasons causing cost changes must be acknowledged and taken into account. Cost concepts and classifications, cost output relationship are the main topics covered in cost analysis in this chapter. 4.3 Cost concepts. Costs are very important in managerial decisions that involve choosing between alternative courses of action. It aids in the quantitative specification of various alternatives. The type of cost to be used in a specific situation is determined by the business decisions to be made. Cost factor into almost every decision, and it is critical to conduct proper cost analysis. As a result, it is crucial to comprehend what these various cost concepts are, as well as how they can be defined and operationalized. Figure 1 shows the types of cost. 4.3.1 Accounting cost. Accounting is a historical cost that records what happened in the past. Accounting costs are the expenses that are recorded in the books of account, such as the balance sheet and profit and loss statements, for the company's legal, financial, and taxation purposes. The accounting cost concept encompasses actual cost. Actual or explicit costs are those incurred by the firm in payment for labor, materials, plant, building, machinery, equipment, traveling and transportation, advertising, and so on. For all practical purposes, the total money expenses recorded in the books of accounts are the actual cost. 4.3.2 Economic costs. There are some costs that do not take the form of cash outlays and are not recorded in the accounting system. They are referred to as implicit or imputed costs. An important example of implicit cost is opportunity cost. Assume an entrepreneur does not use his services in his own business and instead works as a manager in another firm on a salary. He foregoes his salary as manager if he starts his own business. The salary loss represents the opportunity cost of income from his own business. This is an unspoken cost of his own company. Thus, implicit costs are wages, rent, and interest that an owner's labor, building, and capital can earn from their second best use, respectively. Implicit costs are not considered when calculating the business's loss or gain, but they are an important consideration when deciding whether or not to keep a factor in its current use. The economic cost is the sum of the explicit and implicit costs. 4.3.3 Opportunity cost. The concept of opportunity cost play a critical role in modern economic analysis. The opportunity cost or alternative cost are the returns from the firm's second best use of resources that it foregoes in order to reap the benefits of the best use of resources. For example, a farmer who grows sugarcane can also grow wheat using the same factors. As a result, the opportunity cost of a quintal of sugarcane is the amount of wheat output sacrificed. As a result, the opportunity cost of anything is the next best alternative that could be produced instead by the same or an equivalent group of factors at the same cost. This definition must include 2 points. First, the opportunity cost of anything is simply the loss of the next best alternative. Second, important thing is the consideration of an equivalent group of factors costing the same amount of money in the above definition. The concept of opportunity cost is extremely important in economics for the following reasons. A. Assist in determining relative prices of goods. The concept of opportunity cost is useful in explaining how relative prices of different goods are determined. B. Assist in determining a factor's normal remuneration. The opportunity cost determines the value of a productive factor for its best alternative use. It implies that if a productive factor is to be retained in its next best alternative use, it must be compensated for or paid at least as much as it can earn from that use. C. Decision support and efficient resource allocation. The concept of opportunity cost is critical in rational producer decision making. Opportunity cost is a useful economic tool for analyzing optimal resource allocation and rational decision making. 4.3.4 Sunk costs. Sunk costs are those that are not affected by changes in the level of production or nature of business activity. It will remain constant regardless of activity level. The most common example of sunk cost is depreciation, amortization of past expenses. It will remain constant regardless of the level of activity. Sunk costs are also known as unavoidable costs. Even if business activity is reduced, there will be no reduction in this cost. The cost of the ideal machine capacity, for example, is an unavoidable cost. Sunk costs are investments that have no opportunity cost. 4.3.5 Historical costs. The historical cost of an asset is its original cost. Historical cost refers to the cost of acquiring productive assets in the past, such as land, a building, machinery, and so on. The cost of an asset is shown as the original price paid for the asset acquired in the past in historical cost valuation. Financial accounts are based on historical valuation. 4.3.6 Replacement costs. A replacement cost is the amount of money that would have to be paid today to replace the same asset. During periods of significant price change, historical valuation provides a poor projection of future costs intended for managerial decisions. When financial statements have to be adjusted for inflation, a replacement cost is an important thing to consider. 4.3.7 Incremental costs. Incremental costs are defined as the change in overall cost caused by specific decisions. Fixed and variable costs are both included in incremental costs. In the short term, incremental cost will consist of variable costs, cost of fuel, power, additional labor, additional raw material, etc., incurred as a result of the firm's new decision. Because these costs can be avoided by not changing the scale of operations, they are also known as avoidable costs or escapable costs. Incremental costs are similar to the concept of marginal cost but have a broader connotation. While managerial cost refer to the cost of the managerial unit of output, typically 1 unit, incremental cost refer to the total additional cost associated with decisions to expand output or add a new variety of product, etc. 4.3.8 Book costs. Certain actual business costs do not involve cash payments, but a provision is made in the books of accounts, and they are taken into account when the profit and loss accounts are finalized. These are referred to as book costs. Book costs include unpaid interest on the owner's own funds and depreciation on assets. 4.3.9 Out-of-pocket costs. Out-of-pocket costs, also known as explicit costs, are those that require immediate cash payment. Out-of-pocket costs are items of expenditure that involve cash payments or cash transfers, both recurring and non-recurring. This category includes all explicit costs, example wages, rent, interest, material and maintenance costs, transportation expenses, electricity and telephone expenses, and so on. On the other hand, book costs, also known as implicit costs, do not require immediate cash payments. Book costs include salary of owner, depreciation, unpaid interest on owner's capital. 4.3.10 Private costs. Private costs are those that are actually incurred or provided for by an individual or a business for its business activity. Private cost is the cost of production incurred and provided for by an individual firm engaged in the production of a commodity. This cost has nothing to do with society. It includes both explicit and implicit costs. A company wishes to reduce its private cost. 4.3.11 Social costs. The social cost, on the other hand, is the total cost to society of producing a good. As a result, the economic costs include both private and public costs. The social cost of producing a commodity is the cost to society as a whole. It takes into account all costs borne by society, whether directly or indirectly. The firm bear no social cost. It is rather passed on to people who are not directly involved in the activity. The concept of social cost is much broader than the private cost. So, the social cost is equals to private cost plus external cost. 4.3.12 Shutdown costs. Shutdown costs must be incurred when production operations are suspended. When a plant is permanently shut down, some costs must be incurred to dispose of the fixed assets. These are known as abandonment costs. Four point four Traditional theory of cost. The traditional function expresses a technological relationship between physical inputs and physical outputs. Further, the cost function shows the relationship between the firm's cost and firm output given the state of technology. The cost function combines the production function's information with the price of the factors of production. Cost functions are thus derived functions from production functions. Depending on the time period under consideration, the firms have different production functions. Figure 3 shows the different time periods. 4.4.1 Cost output relationship in the short run. A short run is a time period in which some factors remain constant while others change. As a result, in the short run, the firm can only change its variable factors to change output. The short run costs of a firm are the cost of employing variable units of production plus the costs of fixed factors. Thus, the use of both fixed and variable factors incurs cost in the short run. 4.4.1.1 Total fixed costs. Fixed costs are those that are not affected by changes in output. Even if output is zero, they must be incurred. Fixed costs are also known as overhead costs. These include charges such as depreciation on assets, interest on debt, rent of premises, insurance, maintenance cost, property taxes, interest on capital invested, and some administrative costs such as salary of permanent employees, wages of permanent staff, etc. Thus, fixed costs are those incurred in hiring fixed factors of production whose amounts cannot be changed in the short run. These costs are also known as overhead costs, supplementary costs, and unavoidable costs. Figure 4 shows that the total fixed cost remains unchanged and they are not relative to the how much quantity the company produces. So in this figure, total fixed cost is a straight line parallel to the x-axis, depicting that the fixed costs do not vary with the change in the level of output. 4.4.1.2 Total variable costs. Variable costs are the costs associated with the use of variable factors of production, the amount of which can be changed in the short run. As a result, in the short run, the total variable costs vary with changes in output. When the output is zero, the total variable costs are zero. These costs include payments such as labor wages, the cost of raw materials, fuel and power used, transportation expenses, and so on. Variable costs are also referred to as prime costs. Figure 5 shows that the total variable cost curve is an inverted S shape. It reflects the law of variable proportions, which corresponds to a short run period only. 4.4.1.3 Total costs. It is the actual cost that must be incurred to produce a given quantity of output in the short run using both fixed and variable inputs. It is the sum of total fixed costs and total variable costs. It is the actual cost of producing a given quantity of output in the short run using both fixed and variable inputs. It is the total of fixed and variable costs. Figure 6 shows the total cost. The difference between total cost and total variable cost is the total fixed cost. Apart from total cost analysis, it is critical in managerial decision making to have information on per unit costs in order to make objective decisions. The average costs or per unit costs are explained below. 4.4.1.4 Average fixed costs. The average fixed cost is calculated by dividing the total fixed cost by the number of units of output produced. Therefore, average fixed cost is equals to total fixed cost divided by the units of output. The total fixed cost is constant. Therefore, the average fixed cost per unit of output decreases as output increases. The average fixed cost is represented graphically as a rectangular hyperbola. Since the total fixed cost is spread over a large number of units, therefore, average fixed cost decreases steadily as output increases. Because the average fixed cost is a rectangular hyperbola, it approaches both axes asymptotically. That is, it gets closer and closer to the axis until it touches them at infinity. Figure 7 shows that the average fixed cost is in rectangular hyperbola. It reaches both the axes, gets closer and closer to them, but never touches them. 4.4.1.5 Average variable costs. The average variable cost is calculated by dividing the total variable cost by the number of units of output produced. Figure 8 shows the graph of an average variable costs. Average variable cost curve initially falls as the variable factor's productivity rises, resulting in higher returns. It then reaches a minimum at the point where the optimal combination of fixed and variable factors is in place. As the output is increased further, the average variable cost begins to rise as the variable factor's efficiency decreases from its maximum level, and the combination of fixed and variable factors becomes suboptimal. 4.4.1.6 Average costs. The average total cost, or simply average cost, is the total cost divided by the number of output units produced. Now, since the total cost is the sum of total variable cost and total fixed cost, the average cost is also the sum of average variable cost and average fixed cost. Figure 9 shows the graph of average cost. Graphically, the shape of average cost curve is determined by the shape of average fixed cost and average variable cost curves. Average cost initially falls, reaches a minimum at the plant's optimal utilization level, and then rises again. 4.4.1.7 Marginal cost. The marginal cost is the cost added to the total cost of producing one more unit of output. In other words, marginal cost is the cost of producing n units rather than n minus 1 units added to the total cost. So basically, marginal cost is the change in total cost due to production of one more additional unit. If change in output is greater than 1 unit, then the marginal cost can be found over a range of output as well, where marginal cost will become the change in total cost upon change in the unit of output produced. The marginal cost curve is a U-shaped curve. It initially falls with increasing output due to more efficient use of the variable factor as output increases, and then it slopes upward as further increase in output negatively impacts the variable factor's efficiency. Figure 10 shows the short-run marginal cost. 4.4.1.8 Relationship between average cost and average variable cost. First, average cost and average variable cost are both U-shaped, illustrating the law of variable proportions. Secondly, the marginal cost curve intersects the average variable cost and average cost curves at their minimum points. The minimum point of average cost comes after the minimum point of average variable cost. The minimum point of average cost is to the right of the minimum point of average variable cost. Additionally, the behavior of the average cost curve is determined by the behavior of the average variable cost and average fixed cost curves. Furthermore, initially both average variable cost and average fixed cost are falling, resulting in a precipitous drop in average cost. The average variable cost begins to rise after reaching its minimum point. The average fixed cost is still in decline. The rate of fall of average fixed cost is greater than the rate of rise of average variable cost until the minimum point of average cost. Lastly, beyond that level of output, the rate of rising average variable cost offsets the rate of falling average fixed cost, causing the average cost to rise. It is also possible to observe the average variable cost approaching the average cost asymptomatically. This is due to the average fixed cost, which continues to decrease as output increases, which in turn shrinks the distance between average cost and average variable cost. Figure 11 shows the short-run cost curve. 4.4.1.9 Relationship between average cost and marginal cost. Point number 1. When average cost falls, marginal cost is less than average cost and lies below average cost. Point number 2. At the minimum point of the average cost curve, the slope of average cost is 0. At this minimum point of the average cost curve, AC is equals to MC. Point number 3. When the slope of average cost exceeds 0, that is, the average cost is rising, marginal cost will be greater than average cost and will lie above it. 4.4.2 Cost output relationship in the long run. The long run is a time period in which the firm can vary all of its Inputs. None of the variables are fixed and can be changed to increase output. Long run is a period of time long enough to allow changes in the plant, such as capital equipments, machinery, land, and so on, in order to expand or contract output. The long run cost of production is the lowest possible cost of producing any given level of output when all inputs, including plant size, are variable. There is no fixed factor of production and thus no fixed cost in the long run. Because the scale of production may change during this period, the long run cost curves will be subject to returns to scales. 4.4.2.1 Long run total cost. The long run total cost curve shows us the cheapest way to produce any level of output. Each point on the long run total cost curve is obtained by a point on the short run total cost curve, representing the most appropriate plant to produce that output. The plant that provides the lowest possible cost to produce the specific level of output. The long run total cost curve is the one that is tangent to the short run total cost curves. There can never be a portion of the short term cost curve that is lower than the long term cost curve derived from the short term cost curves, because there are no fixed costs in the long run. The long run total cost curve is S-shaped and begins at the origin. Figure 12 shows the long run total cost, and it depicts how at every given level of quantity, long term cost is less than the short term cost. 4.4.2.2 Long run average cost curve. In the long run, all of the production factors are variable, and the firm has a number of options for determining the size of the plants and the production factors to employ. Different short-run average cost curves represent the various plant sizes available to a firm. We can obtain the long-run average cost curve by combining all of the short-run average cost curves. The long-run average cost curve encompasses all of the short-run average cost curves contained within it. It's also known as an envelope curve or a planning curve. Figure 13 shows the long-run average cost. The long-run average cost curve is also a flat U-shaped curve. Characteristics of a long-run average cost curve. Point number 1. Long-run average cost is called the envelope curve, as it envelopes the short-run average cost curve, since long-run average cost curve is derived from the short-run cost curves. Point number 2. No portion of long-run average cost can be above any portion of short-run average cost curves. Point number 3. Each point on the long-run average cost curve is the point of tangency with the corresponding short-run average cost curve. Point number 4. The firm chooses that short-run plant which allows it to produce the expected output at the minimum cost in the long run. Therefore, the long-run average cost helps the firm in decision making and is called the planning curve. Point number 5. Each point on the long-run average cost curves shows the least cost for producing the corresponding level of output. Any point above long-run average cost curve is inefficient because it represents higher per unit cost of production. Any point below the long run average cost is desirable but unattainable. Point number 6. The U shape of the long run average cost curve reflects the law of returns to scale. Point number 7. The long run average cost touches the minimum of short run average cost only in the special case where the optimal plant size is reached. Point number 8. The long run average cost is U-shaped, but the sides are flatter than the U-shaped small run average cost curves. 4.4.2.3 Long run marginal cost curve. The long run marginal cost curves are derived from the short run marginal cost curves. The long run marginal cost is derived from the points of the intersection of small run marginal cost with vertical lines drawn from the points of tangency of the corresponding small run average cost and long run average cost curves to the x-axis. When output is increased by 1 unit, the long run marginal cost shows the lowest additional long run total cost. Figure 14 depicts the long run marginal costs. Now, what is the relationship between long run average cost and long run marginal cost curves? 1. The U shape of the long run average cost curve implies that long run marginal cost is also U shaped. Second, the long run marginal cost curve cuts the long run average cost curve at the latter's minimum point. Third, when long run average cost is falling, long run marginal cost is below it. Fourth, when long run average cost is rising, long run marginal cost is above it. Fifth, when long run average cost is at its minimum point, the long run marginal cost is equals to long run average cost. Shutdown in the long run. As a general rule, a decision to permanently close down, that is, leave the market, should only be made if revenues are insufficient to pay for all costs. It implies that a company incurring losses should eventually close its door and leave the market. The short run is defined as a period in which the business has at least one fixed input or cost. Fixed costs like rentals must be paid even if the business has undertaken production or not. However, in the long, all inputs and costs fluctuate over time. Shutdown is a short-term temporary decision made to reduce losses when the company is not even able to recover its average variable cost. A business may temporarily cease operations, but it may later restart operations if market conditions allow. Even if the company decides to shut down in the short run, the investment in plant and equipment will have resulted in sunk expenses. Therefore, a business may decide to stop operating temporarily before starting up again later in the long run. However, businesses will ultimately elect to leave the industry if conditions do not change. This is a long-term choice. The losses will continue to grow, though until average revenue exceeds average total cost. If the company is unable to raise the selling price per unit to increase overall revenue to cover total cost, the decision to exit the industry is guided by the relationship between the price and the long run average cost. If price is less than the long run average cost, businesses will leave the industry. If the company decides to continue operating, it will do so where long run marginal cost equals marginal revenue. 4.4.3 Relationship between production and cost curves. This section describes the relationship between 1. Average variable cost and average product. Second, marginal cost and marginal product. Now first, let us discuss the first point. Average variable cost is inversely related to average product given the price of the variable factor. Suppose the variable factor is labor and price of the variable factor is the wage rate. And average variable cost is equals to total variable cost divided by the quantity. Since we know that total variable cost is equals to wage into labor, therefore we can write average variable cost as equals to wage into labor upon quantity. We know that quantity upon labor is equals to average product of labor. Therefore, average variable cost is equals to wages upon average product of labor. Therefore, given the price of the variable factor, say wage rate of the labor, the average variable cost is inversely related to the average product of labor. Now, second, marginal cost is inversely related to marginal product given the price of the variable factor. Marginal cost is equals to change in the total cost divided by the change in quantity. Since the marginal cost is only dependent on the variable cost, we can say marginal cost is equals to change in total variable cost divided by the change in quantity. In case the variable factor is labor and the price of variable factor is wage rate, total variable cost can also be expressed as total variable cost equals to wages into change in labor. Therefore, marginal cost is equals to wages into change in labor upon change in quantity, which is equals to wages upon change in quantity divided by change in labor. Thus, marginal cost is equals to wages upon marginal product of labor. Figure 15 shows the relationship between production and cost curves. 4.5 Modern theory of cost. We have learned about the traditional theory of costs in the previous section. In this section, we will learn about the modern theory of costs. Unlike the traditional theory of cost, the modern theory does not agree on the U-shaped cost curves. According to modern theory, the short-run cost curve is soccer-shaped, while the long-run average cost curve is either L-shaped or inverse J-shaped. This is due to the presence of built-in reserve capacity, which provides flexibility and allows the plant to produce more output without increasing costs. The modern theory proposes the existence of built-in reserve capacity, which provides flexibility and allows the plant to produce more output without increasing costs. The short-run cost curve is shaped like a saucer, whereas the long-run cost curve is either L-shaped or inverse J-shaped. The firm, according to the modern theory of costs, can produce a range of output rather than a single level of output as in the traditional theory of cost. Firms construct industrial plants with some degree of flexibility in their productive capacity, so that instead of a single output level, a wide range of output can be produced optimally and at a low cost. The built-in reserve capacity allows for flexibility in the manufacturing process. The saucer-shaped short-run average variable costs are explained by the planned reserve capacity. The modern theory of cost emphasizes the role of economies of scale in allowing a firm to continue production at the lowest point of average cost for an extended period of time. It contrasts to the traditional theory where the average cost rises after the firm reaches the optimum level of output. The firm checks diseconomies of scale by planning ahead of time and enjoys production gains. The L-shaped and inverse J-shaped long-run average cost curves are explained by developments in managerial economics. Figure 16 shows the modern theory of costs. 4.5.1 Short-run average fixed cost. The average fixed cost in modern microeconomics plots as a rectangular hyperbola, just like in traditional cost theory. Figure 17 shows the short-run average fixed costs as per the modern theory, which is identical to the average short-run fixed cost of traditional theory. 4.5.2 Short-run average variable cost. According to modern theory, average variable cost is saucer-shaped and has a flat stretch over a range of output. This flat stretch represents the firm's reserve capacity to meet seasonal and cyclical demand changes. The shape of the average variable cost curve is presented in the figure below. Four point 5.3 Short-run average cost. Average fixed cost and average variable costs comprise the short-run average cost. The smooth and continuous fall in the average cost curve is caused by the average fixed cost curve being a rectangular hyperbola and the average variable cost curve falling and then becoming horizontal within the range of reserve capacity. Beyond that, it begins to climb steeply. The average cost curve looks like this, which is depicted in the figure 19. 4.5.4 Short-run marginal cost. At its lowest point, the marginal cost curve intersects the short-run average variable cost curve. Because the short-run average variable cost curve reaches its minimum point not at a single point but over the entire flat stretch, the short-run marginal cost coincides with the short-run average variable cost curve over the entire range of output corresponding to the flat stretch of the short-run average variable cost curve. The short-run marginal cost curve will be below the saucer-shaped short-run average variable cost curve for any output less than OQ, and it will be above the short-run average variable cost curve for any output greater than OQ1. As a result, the short-run marginal cost curve coincides with the short-run average variable cost curve over the flat stretch pertaining to reserve capacity. Figure 20 depicts the short-run marginal cost as per the modern theory. 4.5.5 Long-run average cost. Modern economists divide long-run costs into production costs and managerial costs. In the long run, all costs are variable, giving rise to an L-shaped long-run average cost curve. This curve initially slopes rapidly downwards but later remains flat or gently slopes downwards at its right hand as depicted in figure 21. 4.5.6 Long-run marginal cost. The shape of the long-run marginal cost curve corresponds to the shape of the long-run average cost curve as per the modern theory of cost. The diagram shows that when long run average cost is L-shaped and the long run average cost curve is falling, the long run marginal cost curve will also fall, and its falling portion will be lower than the long run average cost curve's falling portion. Figure 22 depicts the long run marginal cost as per the modern theory. 4.6 Summary. Both explicit and implicit costs are considered in the economic cost of production. The actual sums paid to the third parties for the acquisition of resources and services are referred to as explicit costs. The opportunity cost connected with using one's own resources for business purposes is one example of implicit costs. Economic profit is the difference between a company's total revenue and total costs, where total costs include both explicit and implicit costs. Opportunity cost is the cost of the next best option that was skipped. Long run and short run costs are distinguished in the traditional theory of cost. In the short run, certain variables are constant while others are subject to change. The short run cost of a corporation are the costs associated with using the variable units of production along with the cost of the fixed elements. Total fixed cost plus total variable cost is added to get the short run total cost, which is denoted as TC is equals to TFC plus TVC. Total fixed costs are those whose total amount does not fluctuate while the output varies. The total cost curve is a horizontal straight line. The change in output level directly affects the variation in variable costs. The total variable cost curve, which reflects the law of variable proportion, is an inverse S-shaped curve. Total fixed cost divided by output level yields average fixed cost. The average fixed cost curve is a rectangular hyperbola. The average variable cost is calculated by dividing the total variable cost by the number of units of output produced. Therefore, AVC is equals to TVC upon Q. Average cost is the total cost divided by the level of output. Marginal cost is the change in total cost resulting from a unit change in output. It is the first derivative of the total cost function. Marginal cost curve is also U-shaped. One should remember that marginal cost is independent of fixed cost. AC and AVC are both U-shaped, illustrating the law of variable proportions. The marginal cost curve intersects the average variable cost and average cost curves at their minimum points. The minimum point of average cost comes after the minimum point of average variable cost. The minimum point of average cost is to the right of the minimum point of average variable cost. The behavior of the average cost curve is determined by the behavior of the average variable cost and average fixed cost curves. Initially, both average variable cost and average fixed cost are falling, resulting in a precipitous drop in average cost. The average variable cost begins to rise after reaching its minimum point. The average fixed cost is still in decline. The rate of fall of average fixed cost is greater than the rate of rise of average variable cost until the minimum point of average cost. Beyond that level of output, the rate of rising average variable cost offsets the rate of falling average fixed cost, causing the average cost to rise. It is also possible to observe the average variable cost approaching the average cost asymptomatically. This is due to the average fixed cost, which continues to decrease as output increases, which in turn shrinks the distance between average cost and average variable cost. When average cost falls, marginal cost is less than average cost and lies below average cost. At the minimum point of the average cost curve, the slope of average cost is 0. At this minimum point of the average cost curve, AC is equals to MC. When the slope of AC exceeds 0, that is AC is rising, marginal cost will be greater than average cost and will lie above it. Longer run average cost is called the envelope curve as it envelopes the short run average cost curve, since long run average cost is derived from the short run cost curves. The U-shaped of the long run average cost curve implies that the long run marginal cost is also U-shaped. The long run marginal cost curve cuts the long run average cost curve at the latter's minimum point. When long run average cost curve is falling, long run marginal cost is below it. When long run average cost curve is rising, long run marginal cost is above it. When long run average cost is at its minimum point, the long run marginal cost is equals to long run average cost. Thank you for listening.